Byju's has defaulted on loans worth billions of dollars. Byju's investors are pissed. A hostile takeover has begun. What are the legal repercussions? What is the company's plan? Can Byju survive this?
Hi, you're watching TFI, Indian social media's OG.
The unfolding legal drama between Byju's, a prominent Indian tech startup, and its lenders over a $1.2 billion loan default presents a compelling case of the challenges and complexities in the tech financing world. A Delaware judge's recent decision has brought a new dimension to this high-stakes financial dispute. The issue began when Byju's, once one of India's most promising tech startups, defaulted on a massive $1.2 billion loan. This default prompted the lenders, which include notable entities like Redwood Investments LLC and Silver Point Capital LP, to assert control over a segment of the education technology provider. This move was validated by a Delaware judge who concluded that the lenders were within their legal rights. In a detailed 41-page ruling, Delaware Chancery Court Judge Morgan Zern addressed the intricacies of this case. The lenders exercised their contractual rights to replace a board member of Byju's Alpha, a special-purpose company established for financing purposes, with their own nominee. This was a critical move, as Byju's Alpha played a pivotal role in the financial arrangements. The legal battle intensified when Byju's challenged the appointment of Timothy Paul, nominated by the lenders to oversee Byju's Alpha. Judge Zern, however, dismissed these objections, affirming that Paul's appointment was legitimate given the defaults. This ruling underscored the gravity of the default and its repercussions on corporate governance. The backdrop of this legal tussle is Byju's struggle to navigate a post-pandemic market. The company, which had experienced a boom in online learning during the pandemic, faced mounting distress as the surge waned. In efforts to manage the crisis, Byju's had been working to sell assets and address the loan issue. This financial strain was further compounded when government investigators searched the company's offices, signaling deepening troubles. The lenders' stance was clear. They were not aiming to take over Byju's entirely, but were focused on safeguarding their rights, as articulated by their legal representation in court hearings. Byju's, based in Bengaluru, India, contested the lenders' actions, claiming their default arguments were unfounded. However, the judge's ruling on November 2nd supported the lenders' position, emphasizing their right to control pledged shares of Byju's Alpha in the event of a default. In a decisive move, Paul, after being appointed as the sole director of Byju's Alpha, dismissed all company officers and assumed the CEO role. This action was part of the legal proceedings initiated by Glass Trust Company, the trustee for the lenders, who turned to Paul to manage Byju's Alpha on behalf of the creditors. Byju's raised concerns over Paul's compensation, suggesting it was excessively high. However, Judge Zern dismissed this argument, indicating that Paul's remuneration was justified and authorized under the court's order. This case reflects the intricate dynamics of lender-borrower relationships in the tech industry, especially in scenarios involving large-scale financing and defaults. The Delaware court's decision marks a significant precedent, emphasizing the legal and financial implications of such defaults and the protective measures lenders may take in response. Byju's downfall can be attributed to several critical factors, notably unethical corporate governance practices and unsustainable growth strategies. Firstly, Byju's faced serious accusations regarding unethical corporate governance. Allegations of accounting irregularities, including inflating revenue and losses, cast a dark shadow over the company's financial integrity. Furthermore, the company's approach to handling user data and aggressive data mining practices raised significant privacy concerns. These issues collectively contributed to a severe erosion of investor trust and a tarnishing of Byju's once stellar reputation. The company's rapid expansion into new markets and broadening of its product portfolio came at the cost of overlooking profitability and operational sustainability. This expansion stretched the company's resources thin, leading to challenges in maintaining consistent quality and personalized learning experiences. The pricing model, which played a crucial role in attracting a broad user base, turned out to be unsustainable in the long run. As customer satisfaction dwindled and the financial model proved unviable, Byju started losing both customers and investors, further exacerbating its financial woes. Byju's failure is a classic case of a tech giant's rapid rise followed by a fall, primarily due to lapses in ethical governance and an unsustainable growth trajectory that prioritized expansion over profitability and operational excellence.